shooting streaks. Miami Dolphins. What's their pattern this year? Okay. All right. Randomness is a difficult notion for people to accept. When events come in clusters and streaks, people look for explanations and patterns. That's from Burt Malkiel, Random Walk Down Wall Street. Our mind looks for patterns because we do that in everyday life. But with investing, it doesn't work because markets and stock prices are random. The market itself prices stocks at what the price is supposed to be. And it's based on all the information and all the knowledge we have about those companies and the markets at this point in time. You've got millions of investors. They're all looking at the same information. No one has an advantage over someone else, except unless you're a professional, because you may have access to more information more quickly than the non-professional, which puts you at a definite disadvantage. The only thing, if all the information that we have today is based on the price of that stock between an independent buyer and an independent seller, what would change the price? Things we don't know. Nobody knew 9/11 was going to happen. Nobody knew we were going to have a tsunami in Japan.
Yeah.
If they did, they'd have bought appropriately beforehand. Markets are random. So we can't identify patterns. No one, including you, can predict the future. Free markets work. They do what they're supposed to. Let's take a look at number 3. Emotion-based decisions. Drawing upon our emotions and gut feelings to make important decisions. Investing, this destroys more portfolios. Back in 2008, I had 2 clients. One did not come through the investor education. The other one did, but I don't know if she was listening. They pulled out in February. March 13th, the market went up. A diversified portfolio recovered almost all of its performance within about a week. Which is missed, both of them missed the entire upside. You stay with it if you have a diversified portfolio. So our emotions can destroy our investments. Gut feeling, you ever buy a car or you get something new and you notice that as you're driving down the road that, I just want a Volvo, and I start seeing Volvos all the time. Right? Okay? Our mind will do that. And it will do the same thing with investing. You will read different things. You will see things on TV, all to support what your gut feeling is. All right? And keep in mind on a trade, when people are buying and selling stocks, that what you may be selling, somebody else has to buy. So if it's that bad, why are they buying? Okay? So, but our natural propensity is to follow our gut, and it destroys portfolios. Let's take a look. When it comes to investing, emotion-based decisions are your enemy. Let's take a look at this one. Investment pornography. Gene Quinn Bryant coined this term. What are we talking about? Nowadays, there is no lack of information about the market. Okay? We are loaded with information. Between the internet, we've got magazines, we've got TV, we've got the talking heads out there, we've got Kramer, we've got all sorts of people. We've got the little baby here for E-Trade. Right? Okay? Well, if he's got enough investing, we got a problem. So, investment pornography is investment information designed to appeal investors' excessive speculation tendency. The financial media is designed to sell products and ideas, not to help you make good investing decisions. What's a magazine depend on?
Ads.
And what do they, in order to get more ads, what do they have to have? More readers. Subscribers. So how do they get more subscribers? With a headline that says, just buy and hold. Or, then these are the 10 best stocks for 2012.
Of course.
Okay? Do they know which ones are? No. Okay. So, overconfidence, an undeserved sense of certainty, ability, or skill. How many here drive? Okay. How many here feel that they are above average as far as a driver? Raise your hands. So we've got 1, 2, 3, 4, 5, 6, and we have
You are
six.
not
Yeah.
average.
6. So we got 7. We got 8 people, and 6 believe that we're above average. How can that be? Because half the room would have to be below, and half the room would have to be above. Okay. Yeah. Well, to be average. Okay, you got to fall here, so half has to be above and half below. Okay, so
It's
We
more
just
than
had all the good drivers in the room, and all the morons are out there.
yeah, walking and get going. That's a good way to look at it. There's a company out of Boston called Valbar, and they've been analyzing the market for over 20 years. And what they do is they look primarily at institutional investors in 401k plans and things like that to see how have they done, how has the average investor done. Now this is done every year, and we're looking at the 91 to 2010 20-year period. The S&P 500 during that time got 9.14. The average investor, 3.83%. What's the problem? The average holding period, 3.27 years. It means they move from one point to another in the portfolio. More evidence of overconfidence. This is pretty good. A former student of mine, this is Daniel Cameron. Former student of mine, Terrence Oden, looked at the prices of stocks 1 year after individual investors bought and sold them through retail brokerage firms. Less the transaction cost, the stocks that were sold did better on average by 3.4%, which means that people are making decisions on average quite bad. They are throwing away, on average, close to 5% of their investment, maybe to 3.4% plus transaction cost. This is solid evidence that people are optimistic and overconfident. They think they can improve their portfolio. In fact, they would be better off just hanging on to it. Very few investors can beat the market, and chances are you are not one of them. I know I'm not. That's for sure. Necessary lie syndrome. Justification applied to imprudent behavior. In other words, we do certain things that may not be real prudent, right? And what do? We justify it. Imprudent behavior, overeating, necessary lie. Sorry, come on. In drinking, just one won't hurt. Maybe one more for the road. Gambling, I'm going to keep going until I break even. I know the next hand I'll break even, or the next spin of the roulette wheel, or whatever. In investing, this time is different, okay? This time is different. Brutal honesty, in what ways have you been investing imprudently while convincing yourself that this time it is really different? You know, are you doing the stock picking, the market timing, or are you looking at the past performance of the manager, changing the funds, or did you buy a lot of tech stocks? Did you buy a lot of U.S. large growth? Let me ask you a question. How many think growth is a higher returning asset class than value? You probably heard that. Have you heard the term value? It's a value stock, or we're doing value investing, or we're doing buy a good growth company, good growth stock. You just pay more. Yeah. That's what Dave talked about. This is one of the lowest performing asset classes. Large growth underperforms historically the S&P 500. U.S. small growth underperforms the S&P 500 historically over an 80-year period. Yet we're our most investors in the market. expect lifelong, long-term to be what? Lifelong. I do expect to structure a portfolio with the highest long-term expected return for my time horizon, circumstances, and risk preferences. We want to put a portfolio together that is scientifically designed. Take the emotion out of investing. We believe that free markets work. I expect the free market to work. I expect my portfolio to look different from my family, friends, and colleagues, especially if they're invested in the S&P 500 or primarily in the U.S. markets, because we want international and we want emerging markets because that will help boost the long-term return of the portfolio. My emotional and instinctual urges, I expect my emotional and instinctual urges to be my worst enemy when it comes to making prudent financial decisions. This is where you need to coach. Because when markets drop, which they will, 1 out of 3 years, it can be quite emotional as far as what you stay with. If the portfolio is diversified, and 94% of the portfolio's return comes from the way it's diversified, don't change it. Because 1 out of 3 years, historically, it's going to be down. We know that. That's why we get higher returns for being in the market, because we have to put up with that volatility. Right? We get paid, rewarded for it. I expect to receive confusing, conflicting messages about the investing from the media. Do not look to the media for investing advice. But I do expect to achieve long-term returns commensurate with the market. If you can't beat the market, what's the best thing to do? Capture the market rates of return. Right? If you can't beat them, join them. I do expect to work in partnership with my investor coach to understand the philosophies and strategies guiding my lifelong investing. You want to work with a coach rather than a financial planner that will keep the portfolio on target and will keep you on target. I expect to remain diversified and rebalance as necessary to maintain a well-structured portfolio. When the portfolio is structured, there's certain percentages in each asset class. If one of those asset classes goes up or down, that no longer means we have the same portfolio. So what do we have to do? We have to rebalance that portfolio so the percentages stay the same. That's another something. To experience peace of mind about my lifelong investing strategy, I expect that. And that's what we're looking to get here. I don't expect to make frequent changes to my portfolio based on current market activity. All you do is rebalance the portfolio. You do not move things around. Don't expect investments that perform well in the past will continue to get superior returns in the future. Past performance, it says it right on the perspective. Past performance is not a guarantee of future performance. They tell you that. I don't expect anyone to be able to consistently and reliably predict which stocks, funds, and markets are going to go up or down. And if I knew who that person was, do you think they would tell me? I don't expect logic to preside over most investing decisions. I don't expect that information advice on TV, newspaper, will help me make me. No, it won't. Think about it. Magazine, by the time it gets to your hand, it took 6 weeks for them to write the articles, get it put together, and so on and so forth. The market's already responded to anything that's in it. I don't expect to consistently beat market rates of return. You don't consistently expect to beat it. Join it. I don't expect my investor coach to effectively predict economic environments and have all the answers. If you expect me to have all the answers, the only one I know is how to diversify the portfolio and to capture market rates of return. I don't expect that more risk will always mean more return. Being in more risky areas of the market or more risky stocks does not equate to higher returns. I don't expect to worry and fret about the state of the portfolio even when the market drops and the returns are so low. Now what we've found is that there's 20 must-answer questions for your journey to peace of mind. If you can get a yes to all these questions, then you should have a peace of mind regarding your investing.